Hi everybody, and welcome to a brand new episode on investing in international funds. In this video, I'd like to focus and address my global audience, people who live outside of the United States, and discuss the topic of international funds as part of your portfolio. Now, unlike for a US person, for you, international funds does not mean the same thing. Yes, you can have home country bias, and this is basically it's actually the natural thing for people to do. They believe in their country, they believe in their region, they believe what's happening in the market. Maybe you live in an emerging market country and you believe that your region will do the best in the long run. That is a possible scenario, and you can have home country bias. Then the question is, should you have a home country bias? Is this something that you can bet on and you can be certain that's going to give you probably the best return on investment? If you want to have analogous portfolio to the folks in the US, you can think of it this way. This maybe help you to arrive at the decision. In the US, people have the home country bias and they can probably afford to have 50, 60, 80 or 100% of their portfolio comprised of the total stock US market. And they can do that, but let's think about it. The US market is about 55% of the global market cap. That is, it holds at least half of the worldwide stock portfolio. So having a home country bias is somehow, it's justified, it's logical, it's probably sound. Now, if you're somebody that lives outside of the United States, chances are your country does not account for 50% of the global market cap. In fact, I guarantee you it does not. So then the question arises, okay, I am a person that lives in Europe or that lives in Asia. How much should I have exposure to the United States? Again, if you're following the global market cap, you can probably safely have about 50-55% exposure to the US market. And that's okay. That's not being US biased, that's not being too much in international for you, because that's simply the global market cap. If you're somebody that, let's say, believes that in the long run, emerging markets, or if you live in a country which is part of the emerging markets, and you believe that the emerging markets will, in the long run, perform better, you can weigh heavily the emerging markets. But remember, emerging markets are only about 10% of the global market cap at the moment. So maybe the smart thing to do is to have only about 10% in emerging markets. Okay, then another thing to consider if you're a non-US person, think about it this way. Think about, if you want to have a globally weighted portfolio, how can you achieve that? One, you can buy a single fund, a mutual fund or ETF, which basically tracks that global market cap. It's the, let's say, total global stock market. So it has US, it has European stock, it has Asian stocks, etc. So it has it in the right proportion. Probably the only thing that it doesn't have is emerging markets. But you can find a fund which has emerging markets as well. So that's one option, where you buy one fund and it does the job. It's everything that you need, market weighted as per the global market. Another option is to buy several major funds which you can give different weights, and you can, let's say, compile your own market cap weighted portfolio. For example, you can buy a fund which is all of the US major stocks. You can buy a fund which is all European major stocks, and you can buy a fund which is all Asian major stocks. And then you can say, okay, I want to have a globally diversified portfolio. I want to kind of follow the global market cap, but maybe I believe more that Asia will do better in the long run, so I don't want to give US 55% as per the global market cap at the moment. Maybe I'll have 30% US, I'll have more Asia and some European stocks. That is a second approach to go about it. The pitfall about this approach, though, is that you're bound to your own bias and your own, let's say, belief or preferences. And by all means, I don't want to insult anybody that's watching, but the likelihood is you probably don't know what's going to happen in the future and which market globally will hold, let's say, a higher percentage, so thus deserves a higher weight in your portfolio. So that being said, going the first route where you buy one fund which is automatically follows the global market cap might be a smarter decision. So if you say, I'm going to comprise my global portfolio of 3 or 4 funds that I pieced together into a global portfolio, keep in mind those are going to cost you money. Each of those funds that you buy, let's say if you buy one for US, one for Europe, and one for Asia, you're going to have to pay different expense ratio for each one of those. And when you combine the expense ratio, it's probably going to be higher than buying, on the other hand, the one fund, which it's a one-shot all. It gives you exposure to the full global market. So you have to consider costs when you're evaluating how you should go about a market-weighted portfolio. But to answer the original question of this video, should you have international funds? And for you, international funds may mean European stocks, US stocks, or the other way around. If you live in Europe, should you have US stocks and should you have Asia stocks? Absolutely. I truly believe that the best diversification that we can do as regular investors, people who are, not necessarily economists who don't have inside information or who don't have the ability to predict the market, and by the way, nobody can, I keep repeating that in my videos, the best thing you can do is you can get what the global market cap returns every year, and to do that, the easiest thing to do is simply buy a fund or a couple of funds which will give you that exact exposure of US, Europe, Asia stocks, etc. in the proper ratio and proper breakdown. So if you buy this one fund, if the market cap changes, say the US is no longer 55% of the global market cap, it drops down to 50 or 45% 5 years from now, that one fund which is tracing that global market cap, that index, is going to also adjust. So basically you're putting everything in automatic. By buying that fund, as the global market cap changes, your exposure also changes with the market cap. So it's basically a no-brainer to me to go that route because, one, you don't have to do any work, so you don't have to speculate, you don't have to keep monitoring which country has the highest amount of stocks, so you need to change your weight. The only thing you have to do is decide which of the brokers that you have access to would give you that one fund at the cheapest price. So I'm not sure if in your country you have options to buy Vanguard. Vanguard has a good fund. It's VWRD, for example. It's one option. And that fund has different, you can buy it in different currencies. You can buy it in British pounds, in US dollars, in euros, etc. So you have to also see what's available to you and what suits you the best in terms of which currency to buy that particular fund. But that's definitely a way to go about. Vanguard is one option, iShares is another option. So there's major companies that offer those kinds of all-in-one fund, which gives you that exposure. Now, I mentioned the last thing I want you to consider also is the currency that you're buying these funds, whether it's international or global diversified one fund. Typically, the major fund families and the major brokerage kind of offerings, they allow you to buy the fund in different currencies. And this is why I also recommend, as you're considering your global portfolio, pick a provider of the fund which gives you that ability to invest in the currency that you're earning your salary. Because let's say you're somebody that lives in Europe and you get paid in euros, probably the most sense for you is to invest and buy a mutual fund or ETF with a global market cap weighting that is in euros, that's denominated in euros. Because the moment you have to convert whatever you're earning to US dollars or British pounds or what have you, you're losing money from the conversion. And then when you're taking the money out, you're going to spend it still in euros. Let's stick with the euros example. So you may still lose money on the conversion rate. So the best thing to do is to buy with the currency that you're earning, buy that fund. So if a fund is not offered in that currency, maybe that will be a driving factor to go to another fund family which offers that similar fund, similar exposure, similar weighting, but it's offered in euros. Speaking of buying the funds, my advice is to stick to some of the biggest brokerage companies, the biggest fund families. They generally would give you the best, the lowest expense ratio for the best and good quality funds where you have even low turnover. But that's a topic for another video. So with that said, I hope we cleared this topic a little bit for you. If you have questions, please put them down in the comments. If you like this video, please give it a thumbs up. And also, if you've got any requests for future videos, or if you've got any questions specific to investing outside of the United States, please let me know, because I believe this is a topic which is not very well covered, and I'd be more than happy to help you out and address those questions of yours. Until next time, talk to you later.